Hi, Bhushan. Good evening. I was not speaking, therefore there was no sound. Hi, Tirumurthy. Evening, guys. Mayuresh Joshi. I hope my video and audio both is loud and clear. If you can give me a thumbs up or some sign, and then we are good to go in the next minute or two. Some other people joining in as well. Hi, Patil Sahab. I'm into saying, and thank you so much, guys, for taking time out. Thank you, Deepak Bhai. Thanks, Mohit. Thanks, Rajendra ji. Thanks, Ravi. Thanks, Sridhar. Fine, great. I think audio and video is patching up superbly. We'll start in the next minute or so. A few more guys joining in. All good, Kush. Hope you're okay as well. Most welcome into. We are learning every day, so that's what my belief is always. Perfect, Kureshi. We'll start in the next minute, guys. Yeah, so just load up the PPT so we can then move ahead. Mukund, yeah. Anything is there, I'll definitely let you guys know. So I think the session here largely is going to be conducted by me. What we are largely going to discuss is the placement of the Nifty and how different sectors are placed at this point of time. I'll brief you about my take in terms of how sectors are probably looking. Ajay ji will definitely talk about distribution days, which are happening in the market at this point of time. And the way forward, as simple as that. So I think I'll be discussing a little bit of macros, some sectors, and some stocks with an absolute compliance angle to the whole thing. We are doing some interesting stuff on the app in terms of certain additions that are happening. So just watch this space. So it's probably we're getting there in terms of more and more features getting added for patrons like you. So guys, anyway, it's 7:33. Let's start without further ado. Thank you so much, Mayuresh Joshi, Head of Equity Research at MarketSmith India. Pleasure to address you today evening. And this evening is memorable on two counts. One, 7 years is what MarketSmith India is celebrating. And as we turn 7, there are a whole host of events planned out for all you wonderful patrons over this day and over the next few days as well. So today, obviously, I'll be conducting this special session in terms of how markets are placed, how different sectors are probably looking. What we've got tomorrow, obviously, is a continuation of what we do always, Bazaar Pe Charcha, but we'll have a little bit of twist to that, as I discussed last time around. We'll probably have a little bit in terms of more additions in terms of buy watch lists that we do probably in MarketSmith. So the TraderSmith webinars will also incorporate that from tomorrow. And more or less in terms of certain elements that we feel, looking at the market condition tomorrow, and obviously what happens tonight based on the US decision and the reaction thereof, on certain sectors which are strongly placed and certain leaders within this. So I think we are tweaking in for our Bazaar Pe Charcha. On Saturday, because I've got a chance to speak to you right now, we'll be having our CanSlim Level 2 session, very exhaustive session. So for all you guys who have not attended that, I think it becomes a very, very incremental addition that you probably can have in terms of value add for the entire O'Neill methodology and system itself. We probably start around 10, 15 odd time. And there is no end to that. So I think if the interesting discussion becomes very interesting, the questions are very, very interesting as well. We can very well go on beyond 4 and all that stuff. So Kaushik, I think there is a link to that. Rucha, you can just forward that link so all the patrons can probably benefit from that. And the third element is that we're going to have a panel discussion on 27th. Very, very interesting panelists that we've got. And it should be interesting as well. So a host of series attached to that. So I think that is one. And second, apart from 7 years, I have joined MarketSmith India in the month of September itself on this very, very day. Tomorrow is the joining date, 3 years back. So I complete 3 years with MarketSmith India. And it has been a very wonderful journey. So I think both these two things are culminating together. markets may be completing 7 years, and I could spend 3 years in this wonderful organization as well. So without further ado, I think let's go to the topic under discussion at this point of time. How the Nifty is placed from an ONI lens. What are we probably looking in terms of D-days, as a lot of you guys have requested at this point of time, and how a lot of different sectors are probably placed from a technical ONI lens, and some fundamentals attached to those sectors on the basic reading that I have got about it. So that's the link that has been sent. You can check on the chat and you can probably join that. That link is for the Saturday webinar, which is the level 2 webinar. As a compliance requirement, as we always do, any stocks that we discuss in this webinar should not be considered as a buy or sell recommendation. A few of the stocks that we have covered here might be part of our recommended research lists. So that goes with a clear compliance mandate that we probably have. Our Saturday starts around 10, 15, 10:30 odds. And as I said, there is no end time. If the discussion becomes very, very interesting, the allotted slot is with a lunch break of 45 minutes, almost around 3:30 is what we end. But we normally end it around 4 o'clock because we take a lot of questions and it becomes very, very interesting. So let's come to the part in which the placement of the Nifty is, right? So everybody of you, I am presuming, are aware of what a distribution day is. But for new users who are probably logging in and are not aware of the CANSLIM system and how the O'Neill methodology works, a distribution day is what we count in a 25-day period. So if I take day 1 today, over the next 25 days, if on a certain day in these 25 days or these 25 sessions that we probably go through, if the index in this matter, if we consider the Nifty, which we do prominently, if the index corrects 0.2% or more with volumes heavier than the previous day, we count that as per the O'Neill methodology as a distribution day. Now, the entire wheel cycle in which we probably have, which I think there is some issue happening. So I'm pretty sorry for this, but there are some issues happening on the laptop where the show mode is probably not happening. We tried that 15 minutes before we logged in, you guys logged in. But certain patches, for that reason, I think you just have to bear with me today in terms of continuing the way it is. So if the punch up happens, what we've got in terms of our Ferris wheel, confirmed uptrend, uptrend under pressure, downtrend, and a rally attempt. In a confirmed uptrend, distribution days are very, very low. It's less than 4 to be very precise. If the distribution days on the count that I gave right now accumulates in that 25-day cycle, there is obviously something wrong in the market because the markets are probably not making newer highs. They're opening gap up, but they're closing at the day's end. A lot of sectors are probably doing that, and a lot of leaders within those sectors are doing that. So I've always maintained time and again on the 3-tier structure that we've always maintained at O'Neill. Look at the index, look at how the sectors are performing, and look at how the leaders are performing within the sectors. And that is why the topic that we've chosen today is the placement of the Nifty, that is the index itself at this point of time, and how different sectors are placed. Because if these two, we gauge that properly, the leaders within the outperforming sectors will be relatively better placed. So if you would have seen our reports when we were in the downtrend and absolutely out of the market in the period of May and June, we had come out with a couple of reports at the end of June, whereby we had indicated that stocks which have not fallen more than 15%, right, are those stocks which in a falling market, when the markets have fallen significantly, where the index itself had fallen anywhere between 14 to 15%, there was larger pain in terms of the broader markets, with stocks falling more than 40, 50, 60 odd percent in certain stocks as well. If within this entire criteria, stocks which have fallen less than 15% is something that can move on as well. So Rishi, I think I am on the presentation mode. There are some issues. I have not moved on to the next slide. So I'll be moving those slides manually at this point of time. So if that probably happens, then you've got certain issues in terms of how the placement of certain leading sectors are. And if those leading sectors are probably coming into some sort of pain, stocks within those leading sectors would also come under significant amount of pressure. And those pressure points are inherently exhibited at the beginning of a fall or when tops are probably made. And that is when we need to identify market tops, which is from the distribution day count. And obviously, as the market churn happens and the downtrend happens and we come into a rally attempt, to find out how the market is probably getting back into a confirmed uptrend. So to realize all that at this point of time and at this juncture, we've got 3 distribution days so far. So if you can see on the chart itself, D1, D2, and T3, along with key moving averages as well, right? So what happened largely a couple of days back with the panic that settled into the market, you probably are also seeing a small box that I've created, which is a stalling day. And Mr. Patil, if I'm not mistaken, asked about what a stalling day was. And O'Neill has clearly written in the book, How to Make Money in Stocks, a certain section and a few paragraphs in terms of stalling day as well. And it was a stalling distribution day. So if you probably look on the left side, where I've probably mentioned on what a stalling distribution day is, the price goes up between 0 and 0.4%. So if you probably look at this arrow right here, right, a stalling distribution day happened on September 9th, which was bunched up between these 3 distribution days that we witnessed. So we witnessed a distribution day a few days before the stalling day was witnessed. And after the stalling day was witnessed, 4 or 5 sessions after that, consecutive days, we probably witnessed 2 distribution days back to back. And on that distribution day, on the third one, we actually breached the 21-day moving averages with very heavy volumes. Now, one can very well argue that on that day, there was some element of MSCI rebalancing that was happening, but volumes were really, really large on that day. And therefore, when you're probably looking at the entire perspective of even a stalling distribution day added up between these 3 distribution days, we're probably having a distribution day count of D4, though we do not count the stalling distribution day as a distribution day, but this has to be taken into account because a stalling distribution day, historically of what we probably seen on the O'Neill lens, invariably means that the market is topping out at some point of time once the stalling days are witnessed. So if there is a further addition of a distribution day, we really don't know what the Fed will probably do tonight, and I will discuss those macro aspects in the next couple of slides after I move through this Nifty slide. If you have a distribution addition happening, we are clearly seeing signs along with the stalling distribution day that we've seen that the market is finding it very, very difficult to breach that 18,000 mark. It did attempt to do that a few weeks before, but it was unsuccessful. And in fact, on Friday, the 21 DMA got breached with heavy volumes, as I said, for rebalancing or otherwise. But if that probably happens, we'll be forced to change our status to uptrend under pressure, which basically means that the distribution day is indicating that tops are made, and certain sectors would also be indicating that, along with certain leadership stocks within those leading sectors, also indicating certain element of topping out in the current market scenario. For your knowledge and information, we are carrying out a very, very special report on stalling days with an example or examples on the market itself. As we've seen historically, you should expect that on this Saturday as one of our learning articles which has come through. But what happens basically in the stalling day, as we put out in the left window, if you can probably see this as the cursor that I'm moving, is that the pricing probably moves at the index level between from a flat level to almost 0.3, 0.4 odd percent. Now the volume is greater or equal to 95% of the previous day volume. So it's almost equal to what the previous day volumes were. At the same time, when you're probably looking at the price up 2 days prior is greater than 0.2%. So you probably look at September 9th, right? The larger aspect that had happened a couple of days before was the price up had happened 0.2% or more. The volume that had happened was 95% or almost equal to the previous day's volume. And what really happens is that it actually closes at the lower end of the range. So the market is stalling. So as simple as that, it just stalls. कुछ हो नहीं रहा है. Gap up हो गया, but gap up sustain नहीं कर पा रहा, it stalls. There is a detailed dedicated discussion which we'll have in Fanslim level 2 in terms of advanced strategies on topping up signals as well, which are indicated by the market, and stalling distribution day also becomes an important and an integral component of that. So if I sum it up at this point of time, we are very, very close to the 21 DMA. The 50 and 200 cluster probably remains in that range of 17,300 and 17,000 odd range. So unless something goes wrong drastically on the global market scenario tonight, and the reactions probably become far more abrupt among the emerging space. I think reaching of those levels at this point of time actually look a little bit difficult. However, I think if the distribution day count increases because of all these factors, you probably will see the markets, as I said, topping out in 18,000 being very, very difficult to take out. And therefore, markets probably moving in a very, very tight range, a very, very broad range between 17,000 and 18,000, and more distribution days added. There is a high element of risk, which data points will then indicate in terms of certain sectors starting to give away, specifically breaking their 50-day moving averages with very, very heavy volumes, and sectoral leadership doing the same as well. So I think the construct at this point of time is that the broader markets are outperforming. FIs are buying significantly into the market. The D-Day count stays at 3, along with one stalling distribution day. And therefore, when you're probably looking at the entire picture itself, if a couple of distribution days gets added, because one distribution day, the D1, which we are talking about, after 25 days expires. So this distribution day is going to expire next week. But if a couple of them are added along with one stalling distribution day, those can become inherent weaknesses for the market, at least from a short-term perspective. And then we'll probably take it forward on how the market data points are paying out over the next few weeks, considering global scenarios, global macros, global markets, our own macros, and the micro development, as I said, from a sectoral perspective and the leadership perspective within those sectors as well. Now let's come to what can probably happen in terms of the US dot plot, right? And the scenario is that everybody talks about how the US bond yields have been moving significantly higher than what the expectations largely were laid out at the beginning of the year. The 2-year has basically moved to 3.99. The expectation in terms of the 10-year moving higher, and therefore more money probably flowing through on the bond yields or US bonds probably seems to be a base case scenario at this point of time. Why I'm saying this? The expectation largely is that, and we'll come to know in a couple of hours time, in 3 hours at around 11:30 Indian time, on what Powell is going to speak and whether he's going to do a Paul Volcker at this point of time. Very clearly says from his commentary that inflation is something that I'm worried about. I don't care about growth. I don't care about anything else that probably happens. The Senate elections are there 3 months, 4 months down the line. And I have to whip and control inflation by any means that is possible, which basically means that the targeted inflation that they've got 2% is a little bit on the it's a little bit more ambitious, if I may put it at this point of time. But I think to get to those levels with aggressive rate hikes and continuing these rate hikes with the dot plot, which was initially expected to land at 3.5, expected to go around 4.25 by the end of this calendar year, and maybe around 4.5 to 4.75 in FY23 as well, with easing off happening at the latter part if inflation cools off at this point of time. So the Fed is probably wanting to risk that they can probably have demand contraction and a soft recession at this point of time, rather than go aggressively in search of growth, and therefore controlling inflation and commentary can go hand in hand as well. Unemployment rate, how the housing stats probably goes through, has always been the case as well when demand probably starts coming down significantly. Yeah, Paul Volcker had raised rates quite significantly. We don't want that to happen, because if probably that happens, you're probably going to see the index stall for a long, long period of time. So the stalling distribution day on September 9 that we witnessed, I think if such a scenario happens and the Fed gets too aggressive, I think probably will probably then be expecting a far larger stalling than probably happened on the index itself. So I think we'll come to know what probably happens at this point of time. But interestingly, what is happening is, if you probably look at the historical S&P 500 yields, the S&P 500 yields have put on anywhere between 5.9 or 6% whereby largely what you're probably looking at in terms of the bond yields and the 10-year landing anywhere between 4.5 with further rate hikes coming through. The margin of safety that happens between a 10-year and the S&P historical yield of 5.8, 5.9% narrows down quite significantly. So I think the risk premium that then one pays for the markets probably starts coming off, which also becomes one of the risk factors, specifically from a US mode and a US market perspective, And that should also be taken into consideration in the entire scheme of things. Europe and the European Central Bank are way behind the curve. So I'll not be pretty surprised, because last time when the discussion happened, I was hearing the press conference, which was live, which was flashed onto the ECB site as well. And I heard Lagarde speak out. And she had no questions, because she was itself not sure in terms of how data points will plan out. And therefore, there was no question about how the terminal rate will happen and at what point of time the terminal rate, or when ECB probably thinks that this percentage is the end rate happening after this periodicity of time. So there is no certainty happening in Europe, specifically way behind the curve at this point of time. Significant rate hikes, there'll be massive demand crunch that is happening, and energy prices which are elevated and through the roof at this point of time. With Russia pulling out a surprise today in the afternoon, with energy going through the roof, you're probably expected to see a very bleak winter that probably comes through. So at that point of time, I think time and again reiterating, if I get the chance, I think I'll probably mail our guys, and they probably might mail you the Shell CEO interview, where he's actually printed a very grim scenario. I think we don't want that to happen for a macro scenario, but even from an individual perspective, because if that probably happens, I think you're going to be in a very, very tight situation as far as risk on assets, specifically equity assets, are concerned. So I think there are macro concerns. Markets are facing the headwinds. At the same time, liquidity is getting withdrawn significantly from global bank balance sheets as well. I was reading an article, in fact, going on to liquidity as well, that liquidity also has become a little bit more averse in the Indian context at this point of time. RBI, in fact, did an OMO a couple of days back to push in certain amount of liquidities. So I think keeping in check also the MIBOR and the LIBOR rates and how they probably move are going to be very, very interesting at this point of time. But with the Fed actions, what will RBI do next week is also going to be very, very interesting. A take which I was speaking with a couple of economics friends in the evening. Their expectation is 25 bips happening in the coming week. Not because that core inflation or inflation is out of control in India. They probably want to balance out the differentials in terms of bond yields between the US and the Indian markets as well. The attractiveness should not go away from the US 10-year and the Indian 10-year, and the gap should not narrow down significantly. Because if that probably happens, you can see significant amount of dollar flows going back to the US market, with the risk premium narrowing on the 10-year Indian and the US bonds as well. RBI has pumped in almost 50 billion out of their forex reserves to protect the currency at this point of time. Whether that decision was judicious or they should have allowed the currency to flow down or depreciate or devalue, I think only time will probably tell us. But we have probably got 50 billion out from our forex reserves in protecting our currency at this point of time. India better placed, as everybody sees as macros is concerned. Tax collections have been reasonable. But can we then have the onslaught of global imported inflation if it comes to our shores at this point of time? And the figure that a lot of economists are working out with, specifically on the trade deficit, if that goes probably out of hand at a certain juncture over the next few months, and the hope is that crude probably stays low, we still buy a lot of Russian crude. But if other deflationary factors play in a favor, it's well and good. If not, I think if the export suffers because of the recessionary factors and the trade deficit balloons off, the current account deficit, which everybody had pegged at around 3%, if that goes off beyond 3%, there can be certain macro challenges because of global reasons. And India will probably have to face a global imported inflationary impact and a global recessionary impact at some point of time going forward if it worsen out. So I think a 75 bips priced in, to put it very, very bluntly. If 100 bips probably happens, which it should not, because I think the high probability is showing a 75 bips for November as well. But then the dot plot would probably indicate larger rate hikes and continuing well into FY23 for that matter as well. Again, coming to the macros, I just discussed that a little bit more briefly as well. But even the China factor is something that one needs to put onto their radar as well. And very little news comes out of China. I think that is the biggest irony and the biggest issue for any global participant, any global analysts. We are a little bit lucky in that sense because we've got a team sitting out of China. So I think we try to poke in and get some information in terms of our Chinese counterparts and colleagues in terms of how the situation is. And they're saying that it is a little bit on the tighter side. You've obviously heard about banks, you've heard about real estate projects. And to put it very bluntly and very frankly, I think the numbers that I probably read through in terms of when the subprime happened in the US, the numbers there were close to 9 or 10 trillion odd dollars. We're probably talking about a Chinese real estate market and the exposure there of both through bonds and the exposure of banks to this as well in excess of 30 trillion at this point of time. So I'm not saying that the real estate market will go bust, but I think there are genuine issues which are probably happening in the Chinese market, both in terms of banks, mortgages, deposits, as well as the real estate market. And bad loans related to houses, as I put it in the last line, have actually surged to 30%. So anything which goes bust there, what is the government going to do in terms of bailout, packages for infrastructure? You're hearing of drought in terms of the Chinese market as well, drought hitting the European markets as well. And every government trying to safeguard both their food reserves at this point of time, including our own government, by putting in more export duties coming through, but effectively raising prices because of lower supply coming through in terms of soft commodities into the market. So I think a few gauges that we also probably track is terms of how the Baltic index is moving, both oil and dry. The oil index basically tracks how crude price is moving. The dry will probably look at how bulk commodities are moving at this point of time. And therefore, I think the more important container rates and routes from Singapore to Europe, from Singapore to the West Coast. And what we're probably seeing at this point of time is that the largest ports in the US, which is Los Angeles and Long Island, the kind of containers that are coming in at this juncture, as I speak to you guys, are 30-35% less on a year-on-year basis. So you've obviously started seeing some amount of pain points come through, both in terms of demand actually getting slowed down. And if this worsens off for any reason, all the reasons that I probably mentioned, these factors should be kept on your radar as well. So I think there are some macro woes. We should not be totally ignorant about it. We should be keeping it on our radar. But the best way to do is the owning methodology, right? Guys, whatever happens, the markets will let us know through the distribution day count. It will let us know in terms of the sectoral allocations or how the sectors are probably moving on the placement of these sectors, the leaders within those sectors. And if you probably get the first hint, like we've always done, we get out of the market goes into a downtrend, we sit on the sidelines, wait till the market gives us signs that things are coming out better. And all those things related to macros will get indicated through data, will get indicated through all the price points that sectors will indicate, and all the price points that global markets will indicate. So because of our global coverage, we'll obviously have the hint in terms of how markets are behaving, both developed, both developing, emerging, and the so-called nascent markets as well. And if such a stage happens, probably we'll be the first to probably understand through our D-Day count, and also understand in terms of how the macros are getting set up across different markets before we start getting in, as the indication will also happen as we get into a rally event, in case we go into a downtrend at some point of time for the next few months. Having said that, as I said, India better placed. I've put out certain aspects on why India is better placed at this point of time. And the expectation in terms of our growth is still going to be humongous compared to other countries. Why I mean humongous is a 7.5% or 8% growth when the entire globe might be moving at 1 or 2%. That 6-7% outperformance at a global level, both through the developed and the developing markets, is humongous. I think I've never seen in my history if this happens genuinely in this year and we outperform by such a margin, that we've anytime done that in the last few years or decades as well. And therefore, I think this decade belongs to India is genuinely the case. As I said, we might get impacted because of certain factors beyond our control, but a lot of things are falling in place for India. And the FIs probably recognize that. So we might have jitters, we might probably feel some amount of volatility going forward. If things worsen out, we might actually feel the pain for some point of time. But we'll bounce back very, very smartly because we are far better placed, not just within the emerging pack, but compared to a lot of developed economies as well. So we've actually taken the UK in terms of GDP. If you probably look at our per capita, and when a comparison was probably made, when the Chinese per capita exceeded $2,000, which our per capita has done over the last few years, the the next few years were exponential in terms of growth. Therefore, I think what probably happens is that it's going to be exponential in terms of the graph that we probably go through. So I think India far better placed, and therefore I think we should be in a far better scenario as we go forward. So this is how we are placed at this point of time. So I think the entire perspective, Anand, the agenda today was basically, as I discussed, if you joined in late, about the placement of the Nifty itself, on how the markets are placed at this point of time, the concerns surrounding markets at this point of time, at a local level and at a global level as well, and therefore the sectoral implications on the market as we see it and as we are talking at this point of time today evening, and going forward as well, looking at our sectoral rotation through the binary, which I'll mention in the next few graphs and next few slides, and the placement on how the Sensex are and how the different sectors are within the index component itself. If you probably look at how the sector heat map is, right, the returns over a 6-month period or a 3-month period have been stupendous, because from the fall that we probably saw, the kind of pullback that we witnessed, I think nobody probably believed that. So I think the pullback that probably happened, I think a lot of people, as we call it, the FOMO part, right, the feeling of missed out, actually got played out, because I think nobody was genuinely convinced that this is probably going to go the way it is. And from the lows of 15,200 till we upgraded this session in terms of our confirmed uptrend with the markets at 16,100. Even from those levels, we have seen a decent 2,000-point rally on the Nifty itself. So if you probably look at the 3-month return, sector-wise, I think it's stupendous. So I think if you probably look at reality as an example, 17.5, the best performing sector obviously was banks and financials, which gave a return of 25%. IT has been a consistent laggard, and I'll probably have a word or two when we discuss sectors on why IT is faring the way it is. But financial services and bank, obviously we distinguish that in terms of the leading banks and a few of the NBFCs within this point of time have performed exceedingly well. Metals and autos were the best performing sectors as well, along with the bank. So I think the initial part of the bottoming out process after 15,200 was actually led by some FMCG stocks, and they faltered out of that. But after that, you probably look at autos leading the pack. And I still remember when we were in a downtrend, M&M was given a nice breakout, but we had to wait because we were in a downtrend. But selectively, I think M&M from the auto pack, Varun Beverages from the FMCG or the consumer discretionary pack. You probably saw a few of the auto ancillaries, stocks like Raj Ratan Wires, if I'm not mistaken, gave tremendous amount of breakouts at that point of time. So I think it was clearly autos, a few of the consumer discretionary stocks, which led the rally, and a few of the capital goods as well. So I clearly remember stocks like Siemens, ABB, and we had a lot of discussions on that as well. And our global focus list obviously added that. Looked at that very seriously, because if a scenario happens and when the markets obviously start bottoming out with the presumption that the worst might be there for the European and US markets. So a lot of the export-oriented sectors, which includes IT, the reason for its strong underperformance, or pharma to a large extent, can still get impacted in terms of pricing pressures. They can still get impacted in terms of demand dynamics, and they can still get impacted in terms of how the entire perspective happens in terms of new business coming through in terms of order flows. So, having said that, I think a few of the export-oriented sectors, like specialty chemicals, also took a hit. But one must really understand that there is a huge opportunity that probably is happening and will still continue in terms of China Plus One. We spoke to a lot of companies. We are meeting a lot of managements before the next results season starts. So me, Vakar, Rushit, Rajshekar, the whole team is looking at a few management calls on qualitative cancelling stocks and generally taking a view in terms of a few elements as well. Specialty chemicals did get a hit on 2 counts. One, input costs significantly higher, and that would remain the case in terms of a lot of aspects related to supply disruptions, so on and so forth. But as input costs are deflating or a deflationary situation is playing out, and as inventory restarting happens at lower levels, with a lot of backward integration happening, activities happening at that point of time, a lot of activities can happen which can be beneficial to these sectors as well. So if you probably look and break certain subsectors within the larger sectors as well, these niche areas might perform exceedingly well. So Deepak, I think we are clearly in a downtrend, but certain stocks, as I said, become outliers, and we could see these stocks becoming outliers. We cannot take a definite call in terms of adding on to the stock because we are still in a downtrend and waiting for the follow through day. But the reason I'm trying to put forth is that in these areas and in this bottoming out process, here the large aspect is that certain stocks become outliers and become great buys as well. But even after the addition, that we added a great number of stocks from the capital goods space, so on and so forth. The performance has been pretty decent. So the sector heat map clearly points out in terms of banks, financials, metals, and autos doing exceedingly well. Now let's come in terms of how the sector rotation probably looks at. No, it was not recommended. I'm just saying that there are aspects and outliers, Vikas. So on the sector rotation part, what probably happens is how we probably look at certain sectors through an only lens in terms of the earnings trajectory and how the earnings are expected to play out over the next 26 weeks. So if you probably look at 4 quadrants, right, we've divided this into 4 quadrants. The topmost quadrant is the best quadrant, which explains quite theoretically in what I've probably written onto the slide itself. And therefore, I think financials, if you probably look at this quadrant, is moving towards outperforming and improving. So I think you've probably seen financial stocks do very, very well. But a large element in terms of financial stocks continuing to do well, there are no two ways. I think with the kind of movement that we've seen, there is high element that there can be a significant amount of pullback that probably happens if the market starts pulling back as well, both at the global level and a local level as well. But generally on what we see is that financials are probably moving towards the outperforming and improving side. But probably also expected to see utilities, consumer cyclicals, and transportation put on at this point of time. So Mudwaj, I think there are some issues. I discussed that. There is certain elements that I can't put out. I think there are some issues on my laptop. You'll have to bear with me on this part. So you might probably just expand your own screens when you're doing that. Yeah, thanks for that. So energy, consumer discretionary, capital goods and financials are still looking very, very good. And tech and retail are still looking at an underperforming. So we still believe that tech and retail can be underperforming sectors or sectors which cannot perform at least over the next 26 weeks period. So because we've done that, so it's not that we want to include in the app, but as I said, on a fortnightly basis, we'll be putting out a sectoral rotation because the sectoral rotation does not change. It's over 26 weeks. So once we've got a sectoral rotation done, we don't need to change that quite often, right? So maybe after every month or 2 months, we can have that put through. So we'll have definitely directed the team to do that. On a fortnightly basis, we'll do that, and then it will happen every month in terms of how the sector rotations are. At this point of time, again, financials, utilities, consumer cyclicals, and capital goods, they probably remain one of the best performing sectors. So we added a few financials, we added a few defense stocks, which did exceedingly well. We added a few consumer discretionary, which did exceedingly well. So generally, I think we are moving in terms of tandem on what the O'Neill methodology is throwing at us and all the different data points is throwing. But I think these sectors should be kept on your radar, which over the next 26 months, revolving and rotating basis, relatively should still perform well in terms of the market move. So, Mr. Roy, this is what we call as pan-area institutional software. And there are special data points that we map onto our institutional software in terms of sectoral inputs, data points, top line growth, margin performance, earnings growth, EPS growth, EPS rating, the price trend, the peer comparisons, and a whole host of factors in our factor research at that point of time. So pharma and healthcare largely, I think, would remain a constant. So I think it's largely neutral or roundabout there, because even if you probably look in terms of how the performance has been, it's largely flat. If you probably look at pharma, they largely are underperformed over a 12-month period. And even in this 3-month period, when all sectors are doing exceedingly well, it's hardly given a return of 3.5%. I'll give you a brief about why and the issues faced to the pharma sector as well. Now let's come to individual sectors as discussed in the agenda as well. And what you are probably seeing in terms of the strong outperformance that banks have done over a period of time. Why has that happened, right? One, in terms of the reported numbers during a COVID period was exceedingly poor because of uh, collections efficiency slowing down, uh, a lot of bad debts accumulating on the book relative quarter-on-quarter basis, and therefore provisioning increasing onto their books. The CASA accretion was not happening significantly, and the deposit growth was not happening significantly. Lending, because of lockdowns and patches of lockdown, and also come down significantly if I compare on a quarter-on-quarter basis. So basically, if you probably look out in the COVID period, and once we came out of that, a significant outperformance was indicated, because what really happened is that our banks relatively stood out compared to global banks. And we should actually acknowledge RBI's role in this quite significantly. So the balance sheet strength that our banks have at this point of time, and let's take into account the two sources of income that they have got: the normal source in terms of their lending business, and the NIMs, or the net interest margins, or the spreads that are calculated in terms of jitne deposit aaye or jitna loan diya, the spread that they probably enjoy. So I think that is their core business. And the other is their non-interest income, which is the treasury part of the business. So a certain element of what has happened in the last quarter or two is that treasury yields have moved very violently. And because of that, you probably expected to see what has gone wrong in terms of yield movement impacting the treasury books of banks, and treasury losses being reported specifically in terms of their carry positions that they've got. But if you adjust the entire scenario in terms of how the asset quality pressures are improving, if you look at the GNP and net NPA account, and we had a stack done for large private, medium private, the smaller private sector banks, the larger public, and the smaller public sector banks as well. Therefore, when you're probably having this entire perspective put forth and a lot of parameters put across, I think the improvement was seen across. But the larger will become larger is the argument, and why it is the argument is because of the fact that lending will continue. Digitalization has happened significantly. We read through a few NBFC balance sheets, a few smaller finance bank balance sheets as well, and a smaller part in terms of element in management call transcripts as well, where they're very confident in terms of credit deposit ratios. With interest rates moving higher, I'm pretty sure over the next 3 to 6 months, the deposit rates will go higher as well. And as deposit rates go higher, I think the risk aversion that probably happens for moderate investors towards fixed deposits, they probably improve, because banks will have access to retail deposits at a lower rate, and they can increase the lending rates in a significant manner to protect their NIMs. That spread can happen. And the appetite probably still remains in terms of lending. But then it will become selective lending, because the risk practices that bank follows and the risk-weighted assets to total assets. So there is a ratio that banks follow of RWA to TA, which is risk-weighted assets to total assets. How that ratio plays out is going to be very important. And therefore, banks will also be very selective. And therefore, the larger banks will have a larger say because of digitalization, because of capital adequacy. We hear about tier 1, right? It's nothing but how much capital they have at their disposal to probably increase their expectation in terms of getting to the customer and the service that they probably lend out. State banks are getting there. So if you probably look at state banks, YONO app, right? The figures are outstanding in terms of what YONO has done as an app itself. And therefore, I think banks sweetly placed, huge outperformance. There can be pullbacks, as I said, because of global markets or any scenario related to that as well. And because of that, those pullbacks, if it happens, and if stocks which have extended themselves, especially the larger private ones and the larger public ones as well, as a compliance disclaimer, we obviously have 2 exposures done through the private space in our suggested lists. But generally, I think pullbacks happen. Banks and financials still remain a sweet spot, and they remain in the sweet spot of a lot of FIIs and a lot of domestic mutual fund investors. Yes. If you probably look at FMCG index, right, it is basically moving above its key averages. Now, today's action specifically, if you see it, a lot of FMCG stocks moved significantly. Now, FMCG is typically an index which is very defensive. When the market goes into a tailspin, right, the one thing that probably happens is that you consume to karte rahoge. You'll consume edible oil, you'll be consuming soap, you'll be consuming bread, you'll be consuming biscuits. And there was a very interesting fact that I read about biscuits. Mangalam, one of the CNBC guys, just tweeted it. The US cookie market actually exceeded $10 billion. our Indian biscuit market is around $6.5 billion at this point of time. The US, the Indian population is almost 4.5 times in terms of US, and therefore I think the kind of expectation that one can have with Patanjali getting very, very aggressive into the consumable mode or the discretionary mode in the FMCG part as well, are very, very selective, are going to be very, very uh, optimistic as well when it comes to these counts as well. So I think there is huge scope in terms of spending. And if a risk awareness happens into the markets, I think this is one of the sectors that you should be keeping an eye on, and leading sectors within this as well. So I think Britannia obviously is something that had a lot of momentum and a lot of tailwind within it. But other sectors, including the likes of Colgate, Nestle, they're a little bit low on price tick at this point of time. But as risk awareness happens, if it happens over the next few months, for all the macro and the micro reasons, and even if India is best place, as I said, some impact being felt there and pullbacks happen very violently in markets like these as well as pullbacks start happening. At those times and opportunities like that, FMCG will start emerging as a huge outperformer. I think all these leading stocks might start performing well, and therefore you have to keep one eye open in terms of this sector. At this point of time, it found a very good support near its 50 DMA for the index itself, and today was a good move as well. So somewhere I think it's finding support near key averages, which is very, very important from a O'Neill lens. Auto, again, index moving above its key averages, no two ways about it. It again found good support near its 50 DMA. The entire scene in terms of moving from an ICE to an electric vehicle, that is going to take time. Companies have made very, very strong announcements. A lot of new vehicles have been introduced. A lot of booking has probably happened. But whether the companies can be sufficient or eligible enough to probably give those. Semiconductor issues, as I was speaking to a few of the large distributors in the auto space, are still persisting, is what they are saying. And specifically in high-end vehicles, semiconductors, which are a little bit of a more niche element and application, still remain a big, big issue as well. So I think being very selective here at this point of time, because a lot of stocks, including the likes of NMN and TVS Motors, are way extended at this point of time. If they do pull back for any reason thereof over the next few months, leading stocks like these might become good opportunities for playing in. So I think if they pull back and they settle down into the buying range on low volumes, and they settle down around low volumes and give us that opportunity in the next few weeks, I think leading stocks like these can do exceedingly well going forward. But even auto ancillaries, I think a few of the stocks are in late stage basis. By late stage, I mean that any stage beyond stage 4 can succumb to selling pressure, because what we've seen historically in US and Indian markets, late stage basis can succumb if the market gives a sudden U-turn as well. So I think in the auto ancillary pack, if Rajratan corrects as an example, or Minda comes down in a correction, forms a good base and gives us a chance, I think some auto ancillary companies which are leaders and leadership can be looked at as well. Similarly, I think on the IT side, even if the IT sector is underperforming significantly, it would, as per our sector rotation theory, a few stocks like KPIT and Tata Elxsi. Tata Elxsi obviously has moved largely into a late stage base, and so has KPIT. But if they do pull back and give us opportunity, these leading stocks is something that one should definitely keep on your radar. And such opportunities will come, because as O'Neill himself says, Bill always used to say that bear markets are a necessity because they create leaders for the next bull market that probably comes. So these bullbacks that we've seen, any pullback that probably happens, or a drawdown that probably happens for the pullback that we've seen, for any scenario thereof in the next few months, and all these stocks which have significantly moved higher in late stage basis come down, they correct, and they give us an opportunity. I think all these stocks at the sectors that we are discussing at this point of time, and therefore I thought I'd add IT ER&D as well, because they form an integral part in terms of autos and auto updates as well, specifically in terms of content, in terms of management of cars, and that entire system is moving quite significantly as well. So I think definitely have to keep this on your radar as well. Metals, it rebounded. It is now trading above key averages. But the problem here is two counts. One, on how China will react and behave, because China is both the largest producers and the largest consumer of metals. I was reading an interesting data in terms of not just steel, but metals like copper, metals like lead, lithium, rare earth. So if you probably leave aside a few Latin American countries to the likes of Chile, to the likes of Peru, the likes of Indonesia in certain cases, China rules the roost. Not in terms of the available resources that they've got, but sheerly in terms of smelting and the processing capacities. So ultimately, all these economies rely on China, and therefore the entire perspective that happens is that China controls a large part of this commodity trade as well. Therefore, I think what is happening in real estate in China, what is happening in terms of the entire demand supply dynamics and the reprocessing as well, because China probably consumes and it reprocesses as well at that point of time on a global scale. You're probably seeing LME prices, which is the London Mercantile Exchange prices for metals, both ferrous and non-ferrous, actually peter down. And therefore, how China comes back, specifically out of drought, out of real estate woes, out of deposit woes, out of the entire exposure, as I said, the 30% of retail exposure to real estate, and if that probably goes bust, and the size of the real estate markets itself, all this probably becomes a big issue in terms of metals as a space. So I think it becomes more speculative, and metals, as I've always maintained, and would have heard a lot of industry leaders as well, that you have to probably play the cycle appropriately. So jab top hota hai metal cycle ka, when everybody's going gungo on metals as a sector, I think that's the best time to probably exit those stocks. When it probably bottoms out, and it probably would bottom out in the next quarter or two, or the next 3 quarters as well. And there will be certain leaders within these, leaders like Tata Steel as an example, JSW Steel within the ferrous space, Hindalco, Vedanta within the non-ferrous space as well. If those guys give an opportunity in the next few months, in terms of bottoming out, forming the right side of the base and fulfilling canceling criteria, and that will happen over the next 2 to 3 quarters as they start bottoming out and start moving higher. I think that stage, I think the leaders within those spaces can definitely be kept on your radar. But at this point of time, I think it's more technical bounces and more in terms of short-term trades that you've got, and you need to play the metal cycle even fundamentally, as I said, in terms of when it tops out and when all the managements are gungo, adding capacities, and maybe you are doing that, you probably get out. But I think that is the best performance that they can probably give. And it has been historically seen for metals as a space over the last so many decades that I've been tracking the market, that this always plays out. And similarly for soft commodities, because we are talking about hard commodities, even for soft commodities, whether it's rice, sugar, it's always said that sugar is a 2-year cycle. Now the entire cycle has been overshadowed with the ethanol story. And yes, I think the ethanol story will play out because a lot of capacities are getting added in terms of distillation and distilleries being put forth by all players within the industry itself. Government tenders are coming in thick and fast. The application in terms of adding on the mix to 10% by 24-25 is a positive step as well. And a lot of OMCs have actually floated tenders to that aspect as well. We've also seen in the Brazilian context a lot of sugar being diverted towards ethanol as well. And ethanol pricing is obviously very attractive as well. So if you probably look at the ethanol B mix and the ethanol C mix, it's anywhere between 54 to 65 odd rupees per liter, which is very attractive considering the woes that the sugar industry faced for such huge time periodicities and the political mess related to the sugar sector as well. So for soft commodities, you also need to play those cycles very well. The only issue with soft commodities is that how demand dynamics are happening globally is a very large unknown, because sitting out in India in a Bombay office, in Bangalore, in Gujarat, in Madhya Pradesh, in Tamil Nadu, it's very difficult to gauge how the real dynamics or real rate of change is happening in terms of data points. And therefore, I think playing it in terms of how production numbers are in the beginning, and when you probably know that cycle well, getting in and getting out before that cycle starts turning, like metals, when it starts topping out and everybody starts talking huge numbers about that, the right way to get out of that. It's similar to that in terms of soft commodities as well. So because we mentioned hard commodities, I thought as much that I'll mention soft commodities as well. Reality, fantastic performance during COVID, right? And all the numbers were mind-boggling. The kind of numbers that came for Bombay as a market, right? The registrations which happened specifically as COVID was just ending. The stamp duties obviously had been reduced even during the COVID period as an incentive. And therefore, I think the kickoff that happened for real estate was phenomenal. A few commentaries have been exceptionally good. So commentaries by Sobha, uh, very, very good in terms of the pre-sales that they are doing, the expectation in terms of per square foot realization. Godrej Properties on the way to probably hit that 10,000 crore in terms of top line. Oberoi, a few of their projects, the pre-sales have been very, very good as well. And therefore, when you're probably talking about real estate as a space, right, the outperformance that happened for developers within the real estate market was humongous. Now, the leaders within this spaces and the outperformance like a Sobha or an Oberoi Realty need to be taken and kept on your radar. Godrej Properties, less leverage, asset light model, sitting on a huge land bank and trying to develop in different areas, including Gujarat, in Noida, in some parts of South as well. It's a positive sign, but I think price strength is clearly lacking. So I think leaders obviously remain Sobha at this point of time. They obviously remain Oberoi at this point of time. And to a certain extent, I think keeping an eye and looking at base formation is very, very good as well. I just tweeted today morning. I retweeted, in fact, one of the tweets that one of the Twitter users had done in terms of faulty bases and why paying heed to proper base formation is important, and leaders taking that leadership in that base formation very, very important. But the proxy to this space, right, is also equally important as well, folks. So laminates, plywood players, ceramic players become very, very important as well, because entirely, if you're probably looking at the entire home improvement part of the market, is going to go leaps and bounds over the next few quarters. And therefore, leaders within this spaces, stocks like Century Ply, as an example, Green Ply Laminates, as an example, should be kept on your radar with the same logic that we put forth. Again, they're not recommendations from a compliance perspective, but something that you should be probably having in your radar in terms of leadership and sectoral leadership that can be exhibited by certain stocks within these spaces as well. So home improvement as a theme definitely becomes something that needs to be kept on your radar as well, and leading stocks within that, because leading stocks will outperform the market and the lesser run players by a significant margin. And why we harp upon leaders and leadership stocks is that even though valuations for lower run stocks might be on the lower side, the sheer strength of their balance sheet, the sheer strength of their leadership position, the sheer strength in terms of their earnings pedigree and earnings trajectory are so superior to their lesser known guys or the lower run guys. Excuse me. They outperform when the markets start turning, and they know how to manage their business in a down market as well. Therefore, we can have probably a look in terms of leadership stocks as well. We'll definitely do that, PCR. We obviously have that, but we will definitely incorporate that in terms of a special report that will come through. And we had certain reports. If you probably look into our library as well, please go into our library. Over the last 6 months, we've come out with a lot of reports. And we have mentioned, and those reports are clearly indicating that, but we'll definitely come out with a new report. I'm working on a very fresh idea right now in terms of binding certain things together. So just wait for that. So I think in a couple of weeks' time, we'll actually be dispensing a very good report in terms of sectors and sectoral leaders and so on. Nifty IT performance continues. What has probably happened is commentaries have been robust. Why have they been robust? Because a lot of change that happens is at the end of the calendar year. So by December, if there is recessionary impact in Europe and America, you're probably going to see a lot of companies cut down in terms of IT budgets. It will not be significant, because what even the companies have realized is that automation is a need of the hour, and therefore a total cut down of the budget probably will not happen. But if cut downs happen, you're probably going to see less order flows. Margin pressures are still persisting at this point of time, and therefore the EBIT performance will still remain a little bit soft. On top of that, you probably look at the global players like Accenture are also indicating in terms of a soft patch probably coming through. So the underperformance is probably there. The underperformance might continue for the sector. So unless we get inherent signs in terms of the sector bottoming out, and I told you, we always believe that even if it bottoms out, and if we are, and because we are growth investors, right, as they bottom out and they move up in terms of price strength, that confidence, once that comes through, and even if we get into the stock after it hits the actual bottom, and nobody will be able to catch an absolute bottom in terms of price, I think that point will be far more comfortable, and therefore I think it's still an underperforming sector for us. And all these reasons are still persisting quite significantly, and therefore it is very, very pertinent to note that instead of saying you're underperformance, stay with the performance and have a look at what the sectoral rotation is probably indicating. And as the sectoral rotation indicates certain sectors coming through into the limelight, I think that sectoral rotation can happen in terms of moving up in those sectors and moving out of certain sectors, which are probably expected to be laggards going forward as well. The best way to also do this is look at the industry ranks, the curated list that we probably got. And we did come out with a report as well on that as well. Have a look at that report as well. And have a look at that curated list as well, because it's a very comprehensive list in terms of understanding it, not a brainer as well. You can probably understand that. It's a downloadable format as well, and easy to disappear and understand as well. Still continue my stance in terms of underperformance by the IT sector. Before I go to a couple of stocks in terms of leading, apart from all the discussions that we had, Raviraj had a question on defense. So defense is doing exceedingly well. It's become the most hyped sector, Raviraj. So I think my only issue is that everybody's harping on to one sector at this point of time. And therefore, I think once that happens, it becomes an excessive point in terms of a lot of supply coming through in terms of for that sector itself. So I think a lot of order flows are expected to come through for the sector as a whole. The government is pretty clear about that. I read the French government is probably looking at more and more imports on certain sectors. The US is ramping up its exports as well, and therefore defense budgets globally are going through the roof. So I think as a disclaimer, we had a couple of exposures, but with prudence and expectations of proper risk management, we did book out of that. My only issue is that all things are favorable, all things are positive. But everybody is getting into the bandwagon at this point of time, and therefore the outperformance from this point of time for this sector looks a little bit difficult, because when everybody starts jumping onto one sector, I think a lot of supply pressure start coming through. For the oil and gas, the average realizations for upstream, midstream, and downstream, right? So for upstream companies like ONGC and oil were to the tune of $72 odd. With oil moving higher, the realizations will definitely improve, but there are certain elements in terms of cost pressures which will also improve for that. And largely remains an area where a lot of hit probably gets taken still by the upstream companies. The midstream companies, LNG prices gone through the roof at this point of time. LPG prices gone through the roof. The transmission revenues, specifically a company like Gas Authority, remain strong in terms of volume growth, but somewhere I think the EBIT per SEM comes down. For gas distribution companies, they have to pass it through. So for that, improvement in terms of what probably happens on volume growth for household gas might stay. There is marginal increase. You will have a revision again in October, and it's going to be a substantial one, looking at the basket of gas prices which have gone through the roof. Therefore, the entire aspect in terms of underperformance which can happen can be significant, specifically from an EBITDA per SEM perspective for gas company. For downstream companies, a large element probably happens both in terms of reprocessing and what happens in terms of retail of fuel as well. They also got the division of petrochemicals, and petrochemicals is largely also an offshoot in terms of how crude derivative pricing is. As the crude derivative pricing is stabilizing or coming down, the end product prices of petchem probably starts moving downwards as well. Refining margins on the Singapore side have come down, and therefore what probably happens is that the downstream companies, to a large extent, the pass-through which probably happens is allowed at this point of time, but a complete one had not happened, and therefore the hit might still probably happen. So I think we stay averse from that. There are too many moving parts when it comes to the oil and gas space. Energy exchanges staying away at this point of time because competition and what IEX had reported and news, a lot of news surrounding that. If that probably happens, the dominance that probably happens in excess of 90-95% in terms of the monopolistic aspect of a leadership starts getting very, very shaky. Power Trading Corporation is a big client for IEX. Power Trading Corporation also has a power license that they have on the radar. If at any point of time, they probably start exploring that, volumes automatically reduce, and the other aspect in terms of a new exchange or a competitor coming through and eating in through starts coming through as well. On tire stocks, huge outperformance, two things which are happening positively. One, input prices, as I said, generally the deflationary aspect, because if you probably look at tire, natural rubber, synthetic rubber, nylon tire cord, the beads that probably go in, all prices have come down. a large element of this is attached in terms of crude derivatives. And therefore, what probably happens is that as crude derivatives, as I mentioned, is coming down, these prices start coming down. So I think the inputs for this quarter in quarter two, the hit will still be there on the EBITDA margin. For inputs from Q3, because when they start restocking, then the problem becomes that from Q3, input costs become lower. Demand two counts, OEM, which is the original manufacturer or the automakers, a complete pass-through is not possible, and therefore I think they do take a hit partially in terms of numbers. Replacement market still easier, duty still into impact both on the radials and on the tires as well. So the inverted duty structure has got changed, and therefore replacement market holding up with a lot of activities in Europe getting hampered for specialty chemicals as a space, as an example, for fertilizers as an example, right? There can be opportunities for Indian companies to actually manufacture more and export there, because it's impossible for those European companies to do that. I was reading a report where BASF actually had shut down, and a lot of plants have actually shut down partially or completely as well, which means that the dependence in terms of getting the stuff through. And even if recession happens, so let's get this point very clear, right? Even if a recession happens, it's not that demand is going to collapse completely. There will be still requirements of certain niche elements in terms of consumables. Certain niche chemicals, as Delicious put forth, are still required in niche applications. Caustic soda is still required in certain niche applications. You probably got a few textile companies. I'll come to textile as a sector as a whole. But on this aspect itself, I think there are opportunities that are coming up. And therefore, input costs, deflationary impact, Indian demand remaining reasonable, and export opportunities opening because of shutdowns that we've seen is the entire aspect, because of which all these elements come forth together. Is the best in the price for tires, like cement stocks as an example. Nobody asked me on cement, and the deal that probably got commensurated and what probably happened in terms of the pledge that happened in the subsequent fall in cement stocks. The total capacity stands at 550 million tons. Another 80-90 is getting added over the next few years. Ultratech going to 160, Ambuja, ACC expected to go up to 160 to compete with Ultratech, and therefore the entire perspective which came through on the capital raise is whether that more acquisitions will probably happen in the mid-cap space. जैसे इंडिया सीमेंट है 15 MTPA कैपेसिटी है, JK लक्ष्मी है 16 MTPA की है, you've got Ramco Cement which is around 20-21 MTPA as well. So उनका EBIT पर टन के हिसाब से अगर acquisition हो गया, and the reported EBITDA per ton on 800 to 1100 on whatever report, I won't disclose that for every company, don't have time, will basically mean that supply is going to come in, whether demand catches up for that as well. So it's anybody's take, but a huge outperformance had happened. So similarly to cement, tires का भी वैसे ही हुआ था. The only issue that I've got is the production numbers, as I'm seeing, if they don't ramp up significantly, right, because of chip problems or any other reason whatsoever, and the export markets have a little bit of a lesser demand or a lesser take on what the market is probably believing in terms of double-digit growth, फिर तब issue हो सकता है. But I think a lot of stocks have moved significantly. A lot of stocks are significantly higher as well. Somebody asked a question in terms of textile. Textile में दो तीन चीजें बहुत देखना जरूरी है. In that entire value chain, एक तो आपकी backward integration कितनी है, both in terms of cotton, in terms of yarn, how cotton yarn spreads are, and ultimately your entire integration process. If you are partially integrated, you are dependent in terms of some aspect in terms of that entire supply chain, which might not be in your favor, and therefore you still remain extremely dependent in terms of certain suppliers as well. What we are hearing and what I've been speaking to a few sources I mean, a few of my good friends do work in the textile industry as well. There is certain sluggishness which is happening at this point of time. Cotton prices बीच में कम हो गए थे, वापस ऊपर निकल गए हैं. We are competing with countries like Bangladesh, Pakistan to a certain extent, but वहाँ पे issues हो गए. So Pakistan obviously had floods. Bangladesh had a few of the labor issues as well, and therefore I think the Indian textile market is still holding out. The PLI scheme of 11,000 crores for textile products that got introduced were exceedingly good and in the right direction as well. But maal atka hua hai. So what I'm trying to say is, what I've been hearing is that certain orders are getting postponed. We spoke to a couple of managements in the textile space as well in the last few weeks, and they alluded to the fact that I'm speaking, that certain orders are getting delayed, certain orders are getting stuck at ports, and therefore, even if it's a China plus one theme along with specialty chemicals, थोड़ी दिक्कत जरूर है for textiles, at least at this point of time. Maybe things will improve after Q3, Q4, and things will improve in the sense because of the incentives and initiatives that the government has taken. Export opportunities can be huge for the sector. Hotels, we remained bullish. We did take a call. We booked out as a matter of prudence. We still have an exposure in one of the sectors as a compliance requirement. Generally, I think they should do well. So I think the entire unlock theme that has happened, and the best is yet to come in terms of Q2, Q3. जब Christmas की छुट्टियां आएंगी, I think the rates are through the roof. Even on a weekend, I think you look at rates across properties in India, right? I think unbelievable rates. So I think they're going to have the best time of their lives when it probably comes to reported numbers. So again, the domestic spending, domestic consumer cyclical sectors, which includes hotels as well. I think that probably remains in the right patch, and Pandre is also probably indicating that. Did I miss out something? Construction looks good. Again, part of the capex theme. Large element in terms of the entire thesis behind this is general election 24 में है. Government is going to go all out. In fact, I was reading a tweet in terms of the UP index, और UP index ने तो पूरा शेड्यूल डाला है. कौन सा रेलवे स्टेशन कौन से इसमें हो रहा है, कौन सा एयरपोर्ट क्या टाइम पीरियड पे हो. It's very interesting. I don't remember the Twitter handle, but I think it's UP roads or something like that. Some Twitter handle where they've actually put out Gadkari साहब has promised roads by 24. So election के पहले I think it's going to be big bang. A lot of capital expenditure is going to happen. A lot of orders are going to flow through. And then again, in that entire infra space, one should basically realize the construction है, it contributes 8% of total GDP. तो जो capital good players हैं, जो metro करने वाले players हैं, so it's not only those who are making wagons, as an example, right? The bearing players, we had an exposure there as well. We booked out because of prudence and we hit our targets. So I think all these aspects, they're going to be see incremental scope in business. Road developers, जैसे मैंने कहा गडकरी साहब ने जो targets रखे हैं, I think huge targets have been laid out and we are doing phenomenally in terms of road development as well. So as a space, general elections 24 में भी होंगे, capital expenditure is going to happen significantly, and entire crux in the argument that happens in terms of private capex following government capex over the next few quarters, with more orders coming through, private capex will be entitled or enticed कि orders मिलते जा रहे हैं, capacity utilization which becomes an important an integral component. आज 70% पे अगर languish हो रहा है for certain sectors within this infra construction space, and which also consumes cement, right, to a certain extent. तो ये सब binded होते हैं in a large way. So to that aspect, once these elements start moving and rolling through, that entire wheel starts rolling in the right direction as well. So I think banking lending happens, financial services lending happens. So I think comfortably placed, and therefore you're better placed in that sense. So construction, infra, road development, construction equipment companies should relatively do well, because private capex at some point of time, with more orders coming through and as utilization levels hit 80%, 85%, they will need the urge to have either a brownfield expansion or a greenfield expansion. अभी greenfield में बहुत time लगता है, which is new capacity to build up, but existing infrastructure में कैसे unlock करके we can expand it to have additional lines put through. All these stuff is going to incrementally. So I think it might be a consensus trade now, but our take was always there that this is probably going to happen, and government, because it will go all out and private orders बहुत ज़्यादा आ जाएंगे, you're going to see incremental benefit happening on that one. Insurance has been a laggard. So I think what we have seen in terms of insurance players, prospects बहुत बढ़िया है. So whether you take HDFC Life, SBI Life, no two ways about it. The worst in terms of COVID is over. They have recognized onto their balance sheet a lot of claims that had happened. इतने सालों से धंधा कर रहे हैं, तो जितनी अभी उनकी embedded value है, any incremental business which flows directly flows onto the margin and EBITDA margin and the bottom line. क्योंकि खर्चे उतने बढ़ते नहीं हैं. So if you look at their OPEX ratio to total cost, it does not change significantly, because manpower addition will not happen if more and more orders come through. Digitalization has significantly reduced costs, or इसलिए because they're set in their business as well. I think that entire pass-through happens, but it's never really performed. So I think largely underperformers, and that is the way it is. New industrial logistic policy effective hai, very bold, if I may put it. Interesting numbers that I was crunching through in terms of both rail car and road cargo movement that happened. With more highways getting developed, with more acceptability in terms of better fleet management services as well, and the entire logistics policy as well. Logistics stocks are looking attractively placed. जब line चालू हो जाएगी in terms of the dedicated freight corridor, and as more warehouses start coming through across the country, with more GST implementation, I think specifically on the e-way bills, and the ease of probably doing that in terms of interstate transfer as well. I think all these factors will move very effectively. So I think leaders पे ध्यान रखो. Logistics space में a few of the stocks have moved significantly higher, if I'm not mistaken. All cargo, AGs, but stocks like Blue Dart, TCI, they're all leaders within the spaces. Interesting, I think it's not related just to the policy. A lot of things are moving and should move as things improve. Because जैसे मैं कह रहा था, जैसे capex होगा, जैसे सारी चीजें होंगी, जैसे bind होगा, this industry will feel the एक जो बोलते हैं ना, जो एक tail shot होता है, they will definitely witness that at some point of time. So, I mean, just stick with the leaders as well. New platform companies, very selective. कोई एक चलने वाली है, as simple as that. So which works, God knows. So we stay away from that because पता नहीं चलता. I think a few IPO bases did work out, but it has to be selective, and if you get in, I think you have to get out very fast as well. But a lot of these companies are basically doing nothing on the EBIT and the bottom line. अगर bottom line growth ही नहीं है तो EPS growth क्या होगी? And we follow strictly the EPS rating as well. So as simple as that. Hospital sector expected to do well. Expectation largely in terms of both opt-out surgeries जो हो रही थी, that has started. Medical tourism has started. The revenue per operating bed has shown signs of stability and improvement. Asset light model follow कर रहे हैं. A lot of pledges are getting off the balance sheet, specifically for leaders like Apollo Hospital. Pharmacy business is picking up. New hospital contribution has started doing very well. Players like KIMS are showing signs of improvement as well. Nara and Durgala are showing signs of improvement as well. And specifically for these newer players, the new hospital का जो EBITDA है, that is turning around. So that's the best part. So I think जितना capex इन्होंने डाला है था सालों पहले, all that capex is now bearing fruit, and as that bears fruit, incremental earnings will be very superior as well. So I think it's very interesting, and all the stocks that you're probably mentioned. New update for MSI because we'll put forth on all those aspects as well. Some leaders like Bajaj Finserv, and it's just not insurance; it is also into a lot of other aspects as well. Have done well. They got hammered also in the fall that we've seen. But obviously, I think it's something which leaders will keep on performing well. Aviation, no views in general. Too many moving parts, too much competition coming through. So it's more a technical call, a short-term call that we're taking. Specialty chemical, I mentioned that. सिर्फ क्रूड से नहीं है, क्या केमिकल बनाते हैं उसके ऊपर भी है, because inputs are also very important for specialty chemicals. End product किससे बनता है और क्या केमिकल लगता है वो बनाने के लिए, right? That's extremely important. I think a lot of these chemicals are expected to import from a lot of Southeast Asian economies, so on and so forth. And therefore, I think you need to be very selective in terms of understanding the entire business dynamic and not be able to explain in a couple of minutes because it's a huge sector. एक शायद एक special chemical में एक अलग सा session करते हैं. So if you guys are okay, we can do that very separately because it's a huge sector. I would love speaking about any sector, but we'll now, like we had done during the COVID time, what I was also thinking right now as I'm speaking, we will take one specific sector and discuss that in detail. And I'll be extremely happy to share whatever information that I've got to the limited knowledge that I probably possess. Because offers and all, you'll have to ask the team. So not the right forum right now, but you ask the team, they'll definitely get back. So, Okay, a few of the slides that we missed, a few of the stocks that are looking good. ICICI Bank, one of them, self-explanatory, not mentioning that too much. Again, as we always say, good accumulation on the right side of the base, perfect example for that. Financials staying within our top quadrant as far as Panry is concerned. And similarly, within autos, within FMCG, ITC performed exceedingly well. So any pullbacks that happen, uh, more than happy, as I said, along with all the others, as I said, where pullbacks are necessary or mandated. And as a rule, as a thumb rule, we do not go after extended stocks as well. So again, self-explanatory at this point of time. And last but not the least, Maruti Suzuki. It's right in the base at this point of time, but we're just waiting out in terms of how it is playing out because it's a little bit shaky out of the stage one cup base that it has come out, and it actually had a shakeout after the breakout was given. But yeah, I think it's looking attractive as well. So Yes Bank, no point in discussing that, Mehul, at this point of time. I think they are going through that recovery process. Asset quality pressures are coming off, but let it show it on the charts. Na? So I'm better off with larger ones at this point of time. Raymond may basically, I think the entire story that is happening with Raymond is largely branded textiles, branded apparel has done well. Real estate expected to perform significantly better. Some of the aspects in terms of their auto part is also doing well. EBIT margins did take a hit in the previous quarter. Debt levels had gone up a little bit on the higher side on a quarter-on-quarter basis. But the entire perspective in terms of core business, which is branded textile, branded apparel, with holiday season expected to do well, obviously need to keep an eye in terms of how cotton prices are, like in the case of ABFRL as well, because it's got a branded portion as well. How yarn spreads are happening. Festive season will be good for them, but somewhere you also need to put for Raymond the real estate part. So real estate is doing well as well. So yeah, ABFRL for the festive season, it might probably do. Tata Consumer will have to wait out because what probably happens in terms of consumption trends, and I said, if risk awareness happens, it's also one of the leading stocks, but let it come out on the right side of the base. So Tata Consumer will be there as well. RHI Magnetia just broken out. Refractories as a space, you go onto my Twitter handle. I've mentioned a few slides out of that. Refractories are needed across industries, whether it's steel, as a process, copper, aluminium, paper, glass, though more frequently needed for industries like steel as well. So yeah, has done exceedingly well, and it has gone through the pivot. I was seeing that in the morning with extremely good volumes as well. Piramal post demerger, still having my doubts in terms of the book that they are carrying in terms of their financial services. Demerger is fine. The core business again. Number stability have to come through. Unless number stability does not come through, it still remains a little bit circumspect on my side. The story for Vinity obviously is in terms of a lot of dependence in terms of crude margin performance will be a little bit on the lower side. It did break out, but it had come off as well. Gujarat Alkali is more a story in terms of how the entire specialty. Well, in fact, we might have a call with the management of both GHCL and Gujarat Alkali as well. So once we have a call with that, we'll anyway be putting a note out. So not contemplating much. Yeah. So that's about it, guys. I've already taken an hour and a half out of your schedule on this busy evening as well. The rest of the queries we'll definitely handle. We've got Bazaar Pe Charcha tomorrow. And as I said, I will do this from the coming month. We'll discuss one sector as we go in detail every time. I hope I made sense in the last hour and a half that I spoke to you. Any other queries that you got, you can definitely write in. If I missed out on something, apologies from my side. If I had some amount of value addition, as I always said, always learning and always expecting that we keep on learning. I'm learning every day, and with you guys, I learn all the more. So please join us tomorrow for Bazaar Pe Charcha, on Saturday for CanSlim Level 2, and on 27th we'll have a panel discussion. Thank you so much for taking your time out. You take care, be safe, till we meet again. Thanks.